This video will explain everything you need to know about contract rollovers and when you should switch over to the next contract. So over here, we are on barchart.com, as you can see, barchart.com, and you'll click select a commodity, you'll come over to the index futures market, and you'll find the NASDAQ 100 E-mini. That's what I have up now. You ignore the cash, and then we have the March contract, June contract, September contract, December contract. We're currently in the March contract. Now, you can really easily tell the contract name because it's right there. The third Friday of this month, which is March, will be when this contract expires, and we have to switch to the next one because this won't even be available to trade anymore. But most of the time, you'll see that before this one completely expires, you can actually begin trading NQM a little bit earlier because the open interest transfers over to NQM, which is the June contract, before this one fully expires. So about a week before it expires, you want to start looking at this open interest level. And the open interest is just the amount of liquidity in the market or in that contract. And when the number on the contract that's out, which is the next contract, aka the June contract, is higher than the contract that we're in, which is the March contract, we'll switch over to the June contract. So when this number becomes higher than 220,000, or when this number becomes lower, so all the open interest from this contract transfers over to this contract, we'll switch and we'll start to trade NQM instead. The volume also matters. It's the buying and selling that's going on. However, the open interest is the main thing you want to look at because that's the amount of available liquidity in the market. And the market with the more liquidity is going to be the one that moves more favorably and with less gaps. So to summarize, we have 4 contracts: March, June, September, December. It works the same for all of them. March contract is NQH, June contract is NQM, September contract is NQU, December contract is NQZ. When the March contract expires, we switch over to NQM, which is June. When this contract expires, we switch over to NQU, which is September. And when this one expires, we switch over to NQZ. This one expires on the 3rd Friday of March. This one expires on the 3rd Friday of June. This one expires on the 3rd Friday of September. And this one expires on the 3rd Friday of December. However, before it expires, we'll probably switch over to NQM before the expiration because the open interest will be higher a few days before the last Friday or the 3rd Friday of the month. And that's it. If you look over here on TradingView, this is the continuous contract from when we rolled over from the December contract to the March contract, and then this is the March contract. So the March contract begins trading before the December contract expires, and that means the price is already set in here for when the contract begins and the other one expires. The price is already there ready. Whereas on the continuous contract, because it's just smoothing out the levels, it goes from whatever the December contract price was, which is 25,103, it'll reprice to what the March contract is going to be. So if the December contract closes at 25,103 and it expires at that price, the continuous contract, which is NQ1 exclamation mark, will have a gap and it'll reprice up to 25,345.75. Whereas on the March contract, we don't see any type of repricing, it just stays there. Now, if you're an ICT trader, you can grade this gap and you can measure the order flow compared to the March contract, but it's not really that important because it only happens once a quarter and it's not even that beneficial, to be honest. You're better off looking at just the regular time and price chart. So hopefully this video was helpful. Thank you for your interest. See you in the next one.